We got some huge news for Opendoor stock investors as the company's management team elaborated on the company's recent quarterly performance and updated investors on new strategies and new products that could have major implications for future shareholders. I'm going to go through these details with you in this video here.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So Opendoor recently started a new strategy where it's connecting motivated sellers with real estate agents. And the company said that their marketing dollars become more efficient as they monetize more of the sellers who come to us. And as we grow transactions, we further leverage our cost structure. And that's true because Opendoor Technologies, one of the ways it attracts new home sellers is through marketing activities, and it's become rather good at that activity, right? Over years of uh, practicing this and iterating and learning and collecting data and improving. Well, now with this new way to monetize those sellers that come to the platform, the company can now bid more effectively or more aggressively for those sellers because now each customer that comes to the company is worth more because they have the potential to monetize across another category and therefore increase the average revenue per customer that reaches out through marketing channels. And so now they can increase their bid in their marketing channels and thereby win more of these bids against other advertisers, which will attract more sellers to its platform. And that could lead to a solid increase in the company's profitability and efficiency as it boosts the number of transactions and revenue overall that they generate. So the company's making these big changes amid very challenging housing market. The second half of 2025 will reflect lower acquisition and resale volumes due to the macroeconomic environment and continued high spreads. So, previous quarter, I talked about how the company's management team was prudently adjusting to the housing environment, the housing market. The housing market has been in this kind of a stalemate for a couple of years now, as sellers are asking for really high prices, and buyers cannot afford those really high prices because of elevated interest rates, and consumer incomes haven't increased by all that much in the last 2 years or so. There was a big increase following the economic reopening and during the pandemic when there was huge growth around the world as governments provided stimulus, sent everyone, or not, I shouldn't say everyone, but sent vast percentages of the population stimulus checks, which fueled consumer spending. And there was a lot of growth. Since then, inflation soared. The central bank increased interest rates to slow down economic activity. And then in 2025, we had the added headwind of the tariffs that are causing uncertainty among business owners who don't know what types of decisions to make based on these consistently or frequently changing tariff policies. And then if you're purchasing or selling a home, it's one of the biggest decisions you're going to make in your life. And when you have all of this macroeconomic uncertainty, you don't know if we're going to go into a recession this year. You don't know what the tariff rates are ultimately going to land at. You don't know how other countries are going to respond to the tariffs initiated by the United States. So all of this uncertainty makes it difficult to make such a big decision. So a lot of homeowners are just putting off that decision, or a lot of people that were interested in buying a house are just putting off that decision. They're saying, let's wait till we have more information and then we'll make a decision later. Finally, the company said continued high spreads. And what that means, and they're not very clear here in explaining what that means. And so I want to share those details with you in this video. Spreads reflects what the management team pays people for the homes they are buying and what they earn when they sell that home. Okay. So if the management team feels like there's a home they could sell for $200,000, they might bid something like $150,000 or $160,000 for that house so that they can take ownership, spend the money, the necessary cost to get the house ready for sale, and then list the property on the market and then sell it, and then earn a reasonable profit in that process, right? Between what they paid the seller and what they were able to sell for. Okay. So during normal circumstances, they have a spread that they're comfortable with. And they haven't really told investors what that spread is that they're comfortable with. But during difficult times like we're going through right now, they increase the spread. So if previously they were bidding 150 for a home they think they can sell for 200K, they're now expanding that. So if they think they can sell the home for 200, instead of bidding 150, they'll bid 140 or maybe even 125. Okay. And the reason they're doing that is to create an increase in the margin of safety for themselves, so they ensure they don't lose money on these homes that they're buying, because the housing market doesn't always go up. Housing prices can fall, they can crash. And if you're stuck with all of that inventory that you paid higher prices for, that could put the company out of business. So it's reasonable for them to be prudent like this and expand that margin of safety. By the way, this document I'm reading from is the company's Q2 2025 earnings call transcript. And I've made this highlighted document, available for my channel members. You can see the link in the description for all of the benefits you get for joining our channel, and you can join for less than $5 a month. The company also noted that revenue came in at 1.6 billion, and they achieved their first quarter of adjusted EBITDA profitability in 3 years. That being said, management team said that the next quarter and the one after that, they're probably not going to be profitable again. So this was a one-off situation here where the company was able to deliver profitability, but it doesn't mean that they're going to be profitable on this basis going forward. So during the quarter, they purchased 1,757 homes in Q2, but they're expecting to slow down this purchasing for the next quarter and the one after that. This was slightly ahead of their expectations, but it was still down a lot from down year over year, driven by meaningfully wider spreads. And remember, we talked about spreads earlier. The reason why they purchased fewer homes because they had wider spreads is because they're offering sellers lower prices. And if you're offering sellers lower prices, they're going to reject your offer more frequently. And that's one of the main reasons they purchase fewer homes. But they're okay with that because they would rather have these homes at lower prices and have fewer homes rather than have more homes at higher prices, which could put them at risk of losing more money. They also reduced their marketing budget because they don't want to attract all of these potential sellers, because they understand that many more of these sellers are going to turn down their offers. So they're not going to be able to generate a good average revenue per customer. And so they're lowering their budget because they understand right now they're not making very competitive bids. So these were huge developments for Opendoor stock investors to understand, so that you can make a more informed decision whether you're thinking about buying or selling this stock. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.